Let me save you years of mistakes and maybe millions of dollars. In this video, we are going to talk about 8 mistakes that cost investors dearly. Now, I may look young, but I started investing when I was 14. I got my first job in the investment industry when I was 17, and I worked at Goldman Sachs. I worked at another asset manager that managed trillions of dollars in equities, and I personally have helped direct billions of dollars of investment flows, as well as seen how investment decisions are made at the highest level. I have seen how people allocate billions of dollars, and I've also seen how people make multi-billion dollar mistakes, which is what this video is going to be about. Some of the most common investment mistakes that investors make. So hopefully you don't have to learn from experience. Now, the first one has to do with position sizing. The mistakes that investors make here is either the position they'll start off with is too large, or, and this one's a little more common, they'll keep adding to the position as the stock price continues to go down, perhaps way above what they would have otherwise. And the reason why this happens is that when you do research a stock, you tend to start to like it, and then you say, well, if it's at a cheaper price, then I should like it even more. That's sort of how the typical investing logic goes, and it's generally correct to an extent. There should always be sort of position size limits that you have in your head. And so what I suggest you do instead of sort of just buying into a stock more and more as it drops in price is you think a priori, which means before the fact, of how much you actually want to have invested at max in this stock, regardless of what the price is. And then you go backwards from there. And so if you say the most I ever want to invest in a stock is 10%, okay, well, make that 10% not at the current price, but when the price is maybe 60% cheaper. And if it's only 40% cheaper, I'll invest 8%. If it's 30% cheaper, I'll do 6%. 20% cheaper, I'll have a 5% position. At the current price, a 3% position. You have that sort of laid out ahead of time. And so you're not just blindly adding to it as, it's dropping in price. The emotions are going, you're going, I'm not wrong. The stock market's wrong. I'm going to show them. I'm going to keep buying more and more and more. And then maybe you do get that big position sizing. And because of certain psychological factors, you realize that you were not actually paying attention to perhaps something that changed with the business, something you got wrong. And so this is a way to kind of design these risk parameters to keep you from that situation where I have seen some people where they have 40% in their portfolio in one stock and they would have never have had 40% invested in that stock if at the outset that was the price they were looking at. It was because it started to go down and down and down in price, and every time it went down, they felt like they had to just buy more. They felt like they had to do something. And so this first mistake is position sizing, and in specific, buying more and more of a stock as it goes down in price and not having any sort of risk parameters set out beforehand, before, the stock price drops, before the emotions come into play. And so I have seen that play out with many investors, and you probably have too publicly, where investors keep doubling down and you're like, dude, why are you doubling down on this bet? Like, I understand why you maybe made it a small portion, but it just keeps getting bigger and bigger. And very often it has to do with ego, having to prove to be right. And those are just not good reasons to invest. Whereas if they maybe at the outset were offered this opportunity, it'd be a small bet for them. But because of kind of the sequence of the price continuing to drop, they keep getting more and more pulled in it. So be aware of that as an investor. That is the first one. The second one, a little related, and the two do kind of go together very often, and it is overlooking info that does not match your original investment thesis. This is totally natural to do. There are all sorts of psychological biases where we screen out information that does not agree with us. As human beings, we just like to be in agreement, and that not only includes other people's opinions, that includes what we think of ourselves and our own opinions. And so it's just naturally going to happen that you're not going to weight people that disagree with you. It's also tricky because as an investor, you are taught that you need to take an opinion and you need to kind of stick to it despite someone maybe disagreeing with you. In fact, I've taught that exact lesson on this channel, that if you do have a strong opinion, don't expect other people to agree with you, because the whole point of investing is that you have an opinion that is different than other people. So this gets tricky. When other facts kind of come into play, how do you weigh them? Can you really come with a clear state of mind and reanalyze this situation without all of these prior judgments and conclusions that you have? This is probably honestly one of the hardest things to do as an investor because you have to really try to take into account new evidence and not pollute it with your prior thinking. The one suggestion I have here, and this may be a little surprising, but I think it's very helpful to sometimes just put all of the analysis away and try to meditate, literally close your eyes, don't think about anything, and try to get to the point where you're not thinking about the stock analysis or anything like that, and it's just totally out of your head. And maybe this, if you're not, great at meditating and all that, that's fine. Just don't think about it for like a day or two. And then when you come back to it, pretend that you don't have any investment in it. You started from clean slate. What is that first decision you're doing? What is your first impulse going to be? And there's going to be a tendency that you're going to want your first impulse to agree with what you said before. And if you see that, that in itself kind of is showing you information that you have a lot tied up in this, that you love your stock a little bit too much. Because if you can kind of just relax, clear your mind of everything, and then what's this first thing that comes up? Is this actually an issue in the stock or not? Reanalyze it from that situation. That could be a way to kind of help you get around this. Again, this is one of the trickiest things, and if someone has a better way to kind of get around this, I'm open to it. Some people, what they'll do is they'll totally sell out of the position and then see if they buy back into it. That's another really great way to do that. Of course, it depends on what's happening in your account, if there's tax implications of selling out or not. If it's in a retirement account, it's a little easier. But that's also another really great way to do this. Just sell out of the position entirely. You could buy it back in 5 minutes or a second if you want to. But sometimes just mentally doing that, it kind of allows new sort of information processing to take place because you don't have this anchor kind of holding you into place. And so that is the second one, is not allowing information. And so that is the second one, is not, and so that is the second mistake, is not taking into account new conflicting information. And the suggestions to get over that are either to meditate, to clear your mind, or not think about it for a while and then see what your first instinct is again from a fresh mind, or just sell out of the position and see if you end up buying it back again. The third one we were going to talk about, this one is one of my favorite ones because I saw it a lot in Wall Street, all of the different finance companies I worked at, and it is borrowing conviction. What that means, and sometimes this is literally the business model, so be aware of that. It means that you didn't do the research and someone else did. And so your conviction is now borrowed from someone else. This sometimes is literally the model of certain funds where there's a portfolio manager that has analysts sit below him, and it's the portfolio manager's job to pick the best ideas from the analyst, but the portfolio manager themselves never did any analysis or really didn't do much. And so they're going to the analyst. The analyst is kind of like pitching them a stock, an investment idea. The portfolio manager is saying, poking around a little bit. I like that. It reminds me of the XYZ situation that happened in my past. That was good for me. And so they go ahead and invest in it. Then if the stock goes down a bunch, they go back to the analyst, what the hell is happening? Why is this stock down? Explain this. Now the analyst maybe kind of knows the business well, and they're saying this was, one of the risks in investing in it, but it's not necessarily a big deal. It's going to pass through, but they're still stuck trying to convince the portfolio manager of that. This was really common with Meta. I'm sorry for continuing to bring up Meta, but it is just such a great example of so many different investing lessons where a lot of people thought that they understood Meta, and then what ended up happening with app tracking transparency, it basically clipped $10 billion of revenue and they stopped growing. And all these portfolio managers were looking at the stock saying, hey, I thought this was a growth stock. I don't really understand what this ATT thing is. Like, is this going to be solved? What's going on here? And, analysts now were kind of stuck trying to convince them that this was a short-term thing. They would return to growth. And then there's all these other issues happening at the same time at Meta that kind of made it harder for a portfolio manager to have conviction in that analyst because the analyst is trying to explain away like 5 different risks at once. They're talking about ATT. They're talking about TikTok competition. They're talking about why you don't need to worry about the FTC. They're also talking about, why you don't need to worry about the 20 billion being spent in the metaverse. Oh, why, by the way, Reels is going to be successful. And even though it's not making any money now and is cannibalizing the service, it's going to be a good bet in the future. And so an analyst is explaining all of these things. And if you're really deep in the stock, then maybe you have conviction in 5 different things. But if you're a portfolio manager and you're like, dude, another risk, like you have to explain all of these to me, you're probably just getting out of the stock. And I think that's one of the things that happened, why Meta had such big drawdowns, is the people invested in it didn't really understand all these situations, didn't really care to learn them all. A lot to go on there, and it's very hard to ever attribute, a stock drawdown to specific variables. But that is what the third lesson is going to be, is borrowing conviction. Don't do it. If you own a stock, understand why you own it. That doesn't mean you need to be the most researched person in the world on it. It does mean that you did your own research and you understand why you own it. If you don't want to do your own research, there's plenty of other ways you could participate in, the stock market wealth creation. You don't need to directly pick stocks. If you are, though, you should know why you own it. And by the way, another bad reason to own a stock is just because someone you like own it. I don't care if it's Warren Buffett. If Warren Buffett bought Paramount and Occidental and you decided to do the same because he did, guess what? It didn't go well for you. And you also didn't have exposure to all the other investments he had, where those were just small portions for him. And you also weren't Warren Buffett, so you couldn't just shake it off. So please do your own research before you invest in anything. It's great if you're watching these great investors, you want to get ideas from them. I do that all the time too, but you want to understand why you're invested in it. Otherwise, you could have just bought Berkshire Hathaway and had Warren Buffett invest for you. You didn't need to think you were smarter than him picking individual investments out. By the way, you don't get all the opportunities he does in terms of the private deal. So don't borrow conviction. That is lesson number 3, because if you do, the stock's going to draw down. You're going to freak out. It's just what's going to happen. And you're also going to constantly be pestering the person where you found the source of information from. What's happening with the stock? Should I own it? Should I sell it? That's, by the way, why with my investment research company, I never give recommendations, because I don't want the stock to go against someone. Then they're coming to me and I'm responsible to convince them to try to stay into the stock. I didn't want to do that. So that's why I don't recommend people borrow conviction. The fourth idea that we are going to be talking about here is selling great companies too soon. It is very often, if you are investing in a great company, a company that is going to compound its sort of earnings over the long period of time, because the money it makes, it reinvests back into the business, and those investments have high rates of return on capital, and it's a good business, so the returns are protected, that machine is going to continue to do that for a long period of time. It's also very likely that there will be periods where the valuation, the price you are paying to get into this business or sell it, gets stretched. Maybe sometimes 30 times, 40 times. Valuations can sometimes get up there. I'm telling you, it's not always a mistake, but at least for me and for many other investors that I've observed and followed, it has been a mistake to sell these companies at high valuations. If you are, and this is a very important caveat, if you are correct in identifying that they are great quality compounders. That is, companies that will continue to grow and take the money they are making and reinvest it back into the business and really benefit from compounding interest over a long period of time. And I can tell you, as someone who owned Apple, 12 years ago, that there was many periods actually where the stock did get a little stretched on valuation. And there was many times where I was kind of tempted to sell, and it would have always have been a mistake. Now, I'm not saying that's necessarily the case today. There's different sort of things going on with Apple, and that's not what this video is about. But I am saying there were instances where the stock's valuation was expensive. And you as an investor are faced with this decision. Do I sell a stock that looks pretty expensive now, or do I just hold it thinking that the valuation is going to eventually catch up to and exceed the price? Now, if you are correct in identifying a stock that is going to compound its intrinsic value over a long period of time, then holding it tends to be the best decision. Because even if you are getting a bit of a premium today, it very often is the case that the value of that business will be able to compound through that premium. Now, that's not always the case, and sometimes valuations can truly get stretched. So my sort of rule of thumb, or where I've landed on this, is I won't sell a great company unless I get what I call a Godfather offer. And I define a Godfather offer as an offer I don't have to think about. And so if you're thinking about whether or not you should sell a great company, don't. If you don't have to think about it, then maybe you should. And the reason why I say that is because it should be just such an absurd price that the business is really just never going to catch up to that. And you could do the math on that. We've talked before about Fermi problems, which are sort of just outlaying simple math to back into what needs to happen with the business to make a certain valuation. So if you're looking at NVIDIA at $5 trillion in valuation, and you want to see what it takes for it to double to $10 trillion in valuation, then just start with 10 trillion in price, divide that by, you want to say a 20 times multiple. So go ahead and do that. That's $500 billion in earnings it needs to make. How much revenue does it need to make in order to have $500 billion in earnings? Do I believe that revenue assumption and that growth? If I do, and I don't think it's crazy, maybe I still hold. If that seems ludicrous to me and I'm worried about it, maybe I don't hold. That is something to keep in mind. And if you are doing that math and the assumptions you're making, you're getting uncomfortable with, and you're like, I don't want to make these assumptions, that's a good reason to not own the stock anymore. However, it's also true that a great company tends to do things you don't expect all the time. A lot of people weren't expecting Google Cloud to come out of Alphabet and be as big as it has been. People weren't expecting Amazon to be able to just continue to grow as long as it has in both businesses, its retail and AWS. And so a great company will tend to do things that you can't expect. But here's the tricky part. You can't expect them to do the unexpected, because once you expect them to do the unexpected, it's priced into the stock and you're already paying for it. And so long story short, if it is a great company, be reticent to sell it unless it is just a very obvious decision to sell because the valuation is ludicrously expensive. The fifth mistake is doing too much research. Now, this is not something you would expect me to say, especially someone that owns an investment research company that produces very long research reports. I'll be honest with you though, a lot of times there is sort of an intuition you may have as an investor that you may get pretty early in the research process. And I'm not saying don't do research after that, but I'm also saying don't ignore that intuition. Because if you have a strong sense you should do something and the research maybe takes a very long time, or there's certain aspects with the business that are just hard to get totally around, but you still really kind of have a strong feeling this could be a good investment, maybe pay more attention to the intuition. And this may not be what you expect me to say as an investor, but this has just been my experience, is that there are times where there's sort of limits to how comfortable you could get with certain questions you're going to ask in the research process. I have an example, which is not a happy example for me, I'll be honest, but I was looking at Broadcom or Vodgo 3 years ago, 4 years ago. It was at the time, I think, trading around 18 times earnings, and I really had a strong feeling on the stock. I really liked it. I liked Hawk Tan. I liked management, but they had a lot of different products and services. At the time, I believe 19, and I felt I needed to understand all of them. And while I was able to understand enough of them, there's one big business in specific they were in, which was called radio frequency chips. And Apple was a key buyer of their RF chips. At the same time, Apple was trying to design their own RF chips. I don't remember exactly, but this was like something like a quarter or a third of revenue, a very large amount. And they had a contract with Apple to supply these chips for, I believe it was another 3 years or something at the time. And all signs kind of pointed to that it'd be a really hard thing for Apple to figure out, and that it really was more in Broadcom's core competency to make these chips. But then there's also like these startups that were kind of working on these RF chips, and there's a difference between high band and low band frequency that I didn't totally understand. And so it gave me some kind of trepidation. And then, I'm thinking, well, Apple's a pretty big company. Is it really going to be that hard for them to come up with an equivalent chip? And this was kind of a question I was wrestling with. And I kind of didn't fully dive into that question more. It kind of made me pause, feel like maybe I wouldn't be able to fully understand this company. And so I kind of just passed in a way. I really didn't even make a decision. I just kind of moved on to other things. And I can see now that my mistake there was I should have, one, trusted my intuition, that I don't feel that strongly about stocks that often. And so if I did, I should have either really continued on that research path to answer that question that I was really having trouble finding an answer to, instead of honestly kind of just, this is too hard and moving on. Because there's not a lot of opportunities you're going to find for a great investment. So you really should push past those friction points. You don't have to, but if you do want to find a great investment, you're probably going to have to sometimes at least. But I think the other thing and the real lesson I would take away from that is that if I diligenced Hawk Tan and management enough, and they've been able to navigate this issue for the past, 15 some years, and have really done really smart acquisitions and have technically managed this company so they've been able to stand out ahead with their product suite, why couldn't I trust them? Why did I think I needed to understand how they were going to compete in radio frequency chips? I could have just trusted management that they would have a solution to that and just monitor it as it goes along. And so if news articles and stuff did come out that could potentially be an issue and that threat is rising, then maybe I do take a different action. And so I think that was one of the bigger mistakes I've made. It is a mistake of omission. So I didn't technically lose money, but it feels like I lost a lot of money. And so the takeaway there for you is going to be, if you have an intuition on something, and by the way, don't fake this. You won't have this very often, but if you do have a strong feeling on a stock because you started researching it for some reason, finish it to the end. For one way or another, finish it to the end and force a decision. If you do want to go down the route where there's some friction point like I had with RF chips, and so Maybe I'm calling up chip designers and people in the industry to understand how hard it is, or maybe I'm going back to history to seeing similar issues management faced and whether or not they have overcome them. Either of those is a fine way to sort of address that, but if you have that intuition, don't abandon it. Keep following until the end and you force a decision one way or another. And so that is the fifth lesson. Do not get research or kind of some frictions with research get in the way of your intuition. The sixth lesson is going to be not looking at something because of a bias. And so the last one was an example of something I was looking at and I just didn't follow it to the end. This one is going to be an example of something where you didn't even want to look at it because you had a pre-existing bias. Now, there's many biases an investor may have about certain industries and businesses that honestly aren't the worst to have because you can only spend your time in so many different areas. But be careful because sometimes great investments are going to go against what common wisdom suggests. And so for me, and many people were invested in Netflix for a very long time, but this is a mistake I made, was that when Netflix did sell off, and I think it was $160 a share, I didn't even look at it. And I know it's kind of embarrassing to say, but I just kind of thought, content, how great is the content business? There's a lot of competition for people's time and Netflix is getting a little bit more into the time spent business. And, I looked at it a few years ago and I kind of thought, North America ARPUs kind of seemed like they're at where they were going to be. And how big is international going to be when you consider pricing power parity? And, it just kind of was like that. That was kind of the feeling I got towards that situation. I just didn't research it more thoroughly, but it was a mistake because at the same time, I remember looking at the stock. It's not so often you have one of the 7 main stocks that everyone talks about all the time and that are, big parts of not just like an index, but also consumer mindshare and retail investor mindshare. And it's a product I use that I liked a lot. And at the same time, it was down, 75+% and it was trading at, I think 16, 17 times earnings. I should have given it some time. And maybe, by the way, the decision I would have came to was that I don't know. And that would have been totally fine if I said, I'm still not so sure that all these streaming services are going to really aggregate into just, maybe Disney and Netflix and like HBO or something, or that all these others will have to sell their content back to Netflix, or that all these other streaming services are going to give up subsidizing their unprofitable customer acquisition cost. I didn't know what conclusion I would come to on any of that. And I'm not here saying this is what I would have done back then, and this is all the decisions I could have made that would have made me more money. That's not what this is about. This is about understanding mistakes in process. And in my opinion, it was a mistake in my process to not even give it a shot. And maybe I looked at it for a couple hours and said, I don't think I'm going to be able to get comfortable with it. But maybe I did look at it and say, oh, this is more interesting than I expected. Things have changed a lot since I last looked at it. And so that is another mistake investors make. I've made it. I've seen plenty of other investors make it too. This is going to be a contentious example, but Tesla, for a long period of time, basically before 2020, Tesla was almost always at bankruptcy risk. But there was a moment when that basically changed. But I don't think many investors updated their sort of look on the stock. And I'm not saying that means you should have necessarily, but if you are trying to, get as many opportunities as possible for good investments, you do want to keep an open mind. And it is a tricky thing to balance. And Nvidia has a little bit of that too, because if you pull it up in 2023, it's trading at 100+ times earnings, but maybe if you researched it and you could have built conviction with, how much growth they were having, which was a tremendous amount because of all the contracts announced and all that. I probably wouldn't have been able to get confidence with that. I just don't generally love assuming 100% growth rates for any amount of time, but certain investors could gain comfort with that. You could do research with that could build your conviction on that. And so this is not just, this after the fact rationalization of all these investments we could have made. This is again about the process and trying to make sure we have in our pool of potential investments as many investments as possible that could work, that have a high probability of working. Maybe Tesla wasn't one of those because there's a lot of things that can happen in a car manufacturer. But maybe it was. It's kind of a little bit about just increasing the number of potential pitches you can swing at. And if you don't swing, that's okay. But at least you kind of had that opportunity to take a look. And it wasn't this kind of old bias keeping you from that. And so that is going to be the sixth lesson, is a bias keeping you from researching a potential good opportunity. The seventh lesson is going to be stock prices dictating your emotions. This is the one everyone knows, but you don't want to really hear it. You want to believe that you're good at this. I'm here to tell you, you're not. I've seen so few people ever actually have their analysis and emotions be totally unhinged from the stock price. It is very often that when a stock price is down, you feel poorly. It is a natural thing for you to feel poorly. You feel like maybe you made a mistake, and maybe you're also getting a little defensive. You feel a need to double down. That goes back to the first mistake we were talking about. When stock prices are down, investors tend to want to buy more. They feel like they have to defend their position. And so this is another really important mistake that investors make all the time, is they let the stock price dictate their emotions. To get around this, I like to kind of play sometimes these mental games with myself where I'll say, if I closed my eyes and the stock price was double, how would I feel about it? If it was cut in half, how would I feel about it? I like to do this before I even invest in it too sometimes, where I'll think, if this business was 50% cheaper, what happened? And there's kind of two aspects to that. You could say what happened in terms of actual business risk, but that's not what I'm talking about. But also what happened, and this is more what this is about, in terms of a sentiment shift. And am I okay with that? You know, if you're a value investor type, someone who focuses on the actual business instead of just what the stock price is doing to give you signal, you should be okay with the stock price being down as long as the business is okay. And it goes back to not borrowing conviction too, because if you don't borrow conviction, you have more confidence in the businesses you are owning. And so a stock price drop doesn't influence you as much. In fact, if a stock being down 30%, but the business earnings still being strong is hurting you as an investor, there's a good chance it's because you just don't understand the business well enough. You didn't research it enough, or you're just not focusing enough on what matters, which is the actual earnings power of that business. And so that is another really important thing to make sure you are doing as an investor. Focus on the business, not the stock price. If the stock price is down and you don't feel good about that, that is totally normal. Do not let that drive your decisions. Focus on the actual business and their earnings power. And this goes back to the first mistake again with position sizing, because if you do have sort of laid out what you're going to do ahead of time, it's easier to follow that in the moment. If you have a strong sense of how you're going to allocate money as the stock becomes cheaper, then you're not, in the whim of emotion, just throwing money at your investments. Not a great way to get things done. So that is another really important thing to keep in mind. I do suggest, again, to get around that, you do play these mental games of my investment portfolio is down by half. How am I going to react? If this stock was down by 70%, how am I going to react? What are the real risks I'm worried about in this stock? And if I'm not actually seeing that happen in the business, then I don't actually need to be worried. And it's tricky because sometimes new risks come up that you didn't think about, so you have to reanalyze those. It goes back to, though, trying to reanalyze that from a position where you can have a clear framework of mind. But I'm also going to give you kind of opposite advice that I gave you earlier when I said, if you do have conflicting information, maybe you sell your position and reevaluate. If you do that in this scenario, be very clear with yourself whether or not you're selling that stock because there is new information about the business that you don't like, or if it's just because you're freaked out that the stock price is down. Because more often than not, you are just freaked out that the stock price is down. For whatever reason, it is very hard for people to watch a number go down. And so that is why I suggest you keep in mind the business behind it. And it also goes back to actually the money you being invested is not money you need in the short term. If you do have a long duration on the money you're investing, it's easier to survive these. If you have that emergency saving fund, it's easier to survive this, and you know all your cash outflows, where the money's going to go. And so that is going to be mistake number 7, letting stock prices make you emotional and dictate your decisions. And number 8 is going to be not keeping up to date with the stocks on your watch list or that you maybe own, where the stock price was maybe flat or maybe it's up a lot, but the valuation actually came down. There's a lot of times where a stock's price may be up a lot, but its intrinsic value or how much it's grown earnings actually went up even more. And so that is another mistake investors make, is they're not monitoring that sort of situation. Maybe it is a stock like Nvidia where you see the price is up, 50%, 75%. But since you last checked, earnings are up 80%, 100%. That's an extreme example, but there are a lot of instances where a stock's earnings can continue to grow and compound, and you just kind of assume it's still overvalued because the price is higher than the last time you looked at it, but the valuation could actually have come down. Could have come down because they're earning more. Maybe they have more cash on the balance sheet. Maybe, they have more losses in a different segment that's going to go away at some point too. Lots of things to consider there. So it is really important to be monitoring all of the stocks in your portfolio in case that does happen. Now, we've talked about a lot of different mistakes investors can make, how you can also improve. And so the best way to learn as an investor, though, is to actually learn from real world case studies, what's actually happened in the world. And so watch this video here because it is a real case study on how to actually analyze a stock, research it, and then ultimately come to a good decision in the face of max uncertainty, which is when a lot of these mistakes that investors are making tend to happen. And if you enjoyed this video, go ahead and hit subscribe and like, and thank you for listening.